When people first start investing, they usually ask, what ETF should I buy? But honestly, I think the better question is, what job is this ETF supposed to do inside my portfolio? None of this is financial advice. This is just how I personally evaluate ETFs as someone who built a seven-figure portfolio through investing. Hi, I'm Kelsey. I studied finance at Georgetown and built a seven-figure portfolio, all from investing in the stock market. When I look at an ETF, one of the first things that I ask myself is this a foundation ETF or a specialized ETF? Foundation ETFs are usually broad, diversified funds designed to be the core of your portfolio. For example, Vanguard's Total Stock Market ETF offers thousands of companies across the US stock market. That means instead of buying one company or one industry, you're spreading your money across a huge portion of the market. I personally think of these as like a base layer investment. Then there are specialized ETFs. These are more focused and are usually meant to tilt your portfolio towards a certain strategy, industry, or investing style. For example, technology ETF puts more weight into technology companies like software, AI, semiconductors, or cloud computing. So when people say an ETF has a technology tilt, they just mean the ETF is more heavily focused on tech companies compared to an overall market. Another example would be a value ETF. Value ETFs focus more on companies that are considered cheaper or more stable based on financial metrics. These are often mature businesses like banks, healthcare companies, or consumer brands. Growth ETFs are kind of the opposite. They focus more on companies expected to grow revenue and earnings quickly, even if the stock prices are already expensive. These are often companies in technology or innovative focused industries. The second thing I look for is the expense ratio. The expense ratio is basically the management fee you pay to own the ETF. So if an ETF has a 0.3% expense ratio, that means you're paying $3 annually for every $10,000 invested. A lot of beginner investors don't realize fees matter because even a small fee can compound over decades. Next, I look at performance compared to the broader market. The easiest metric for beginners to look at is an average annual return over different time periods like 1 year, 5 years, and 10 years. That helps you see how the ETF has historically performed compared to something like the S&P 500. For example, if the S&P 500 returned around 13% annually over the last 10 years, but a semiconductor ETF returned closer to 20% annually, that tells you that the ETF historically grew faster, but probably was more volatile and had more risk. On Fidelity, you can actually easily look this up by searching the ETF and scrolling to the performance section where it compares returns across different time periods. I also look at diversification. Some ETFs might sound diversified, but are actually very concentrated. For example, some technology ETFs are heavily dominated by a few companies like Nvidia, Microsoft, and Apple. That's not necessarily a bad thing, it just changes the risk profile of your investment. And finally, I like to think about overlap. A lot of beginner investors accidentally buy multiple ETFs that all own the same exact companies. So even though it looks diversified on paper, you're actually doubling down on the same stocks over and over again. At the end of the day, I don't think picking ETFs is about finding the perfect fund. I think it's about understanding what role each investment plays inside your overall portfolio.